In this video, we are going to talk about can cryptocurrency affect your credit score? So before starting this video, like this video and subscribe to our YouTube channel for future updates. A form of digital currency known as a cryptocurrency is unrelated to any sort of central authority, such as a particular bank or government. Your credit shouldn't be impacted by cryptocurrency. Although cryptocurrency is a hot topic right now, not everyone is aware of what it is, how it functions, or how it relates to your other finances. If you're thinking about investing in cryptocurrencies, you might be concerned about how it would impact your credit score. No, utilizing cryptocurrency shouldn't harm your credit, is the short answer. However, before you start making significant investments in cryptocurrencies, you should have a general understanding of them. A sort of digital currency protected by encryption, exchanged through a computer network, and stored digitally is referred to as a cryptocurrency, sometimes known as crypto or just crypto. This kind of money was developed as a means of exchange unrelated to any kind of centralized authority, such a particular bank or administration. Bitcoin, Ethereum, Tether, Binance Coin, and USD Coin are some of the cryptocurrencies that are currently most in demand. Of course, cryptocurrency has also received a lot of criticism due to some of its flaws. The drawbacks of cryptocurrencies that are most known are: due to the difficulty in tracing ownership, many people use cryptocurrencies for illicit transactions. Cryptocurrencies are regarded as high-risk investments due to their propensity to experience significant market swings, swiftly increasing and dropping in value. It's hazardous to own cryptocurrencies because if you lose your digital wallet, you'll lose the money permanently. The amount of Bitcoin on one man's hard drive, which was unintentionally thrown out with the trash in London, would be worth $280 million today. Although the same risk exists today with online banking and your real money, there is a chance that someone will break into your computer and steal your digital wallet. Taxes apply to cryptocurrencies. Your digital wallet will be taxed at the same rate as traditional assets, like as gold and stocks, according to the US government. A digital coin known as cryptocurrency is built on blockchain technology and is encrypted. Blockchain is a type of distributed ledger that gives cryptocurrencies a method to securely store and move data. The blockchain, to put it another way, is similar to a ledger that records cryptocurrency transactions between authorized users. Without the confidentiality and security that cryptography provides, blockchain technology would not be practical or efficient. In order to prevent unwanted people from accessing cryptocurrencies, cryptography helps encrypt them. These components combine to produce the secure, anonymous digital coin that cryptocurrency promises, one that can be readily exchanged between authorized users without being monitored by a centralized entity like a government. Unless you buy cryptocurrency with credit, it cannot harm your credit. Hopefully you won't encounter this problem, as the majority of financial professionals advise against purchasing cryptocurrency with credit. Because cryptocurrencies are so erratic, using a credit card to buy them puts you at danger of debt, hefty credit card interest, and transaction costs. Imagine using your credit card to purchase $10,000 worth of cryptocurrencies, and the value of that particular digital coin plummets the following week. Not a situation anyone would want to be in, when $10,000 is now only worth $100 and you still have to pay off your credit card at a 22% April. Some credit card providers don't let cryptocurrency purchases because of this volatility. You may buy more than 1,500 different kinds of cryptocurrency. Choose the cryptocurrency that is ideal for you as your next action. Do your study and choose what fits with your investment objectives. You'll need to decide where to store your Bitcoin while you're buying it. Both hot wallets and cold wallets are secure methods for storing cryptocurrency. A form of Bitcoin storage known as a hot wallet employs internet software to safeguard the private key that houses your funds. Cold wallets, also known as hardware wallets, are offline electronic devices that function like hardware disks and hold your private keys. In contrast to cold wallets, hot wallets frequently don't impose fees. Despite expansion, there are currently only a few items you may purchase with cryptocurrency. Products and services offered by tech firms and by some online stores. Examples include Rakuten, @and Amp, Shopify, Home Depot, Overstock, and Microsoft. It's up to you to decide whether or not to purchase cryptocurrencies. Keep in mind that you can purchase Bitcoin anonymously and that it is partially protected from growing inflation rates. However, there are hazards associated with it, such as the erratic cryptocurrency market and the potential loss or theft of your digital wallet. It is advised against investing a disproportionate amount of your portfolio in cryptocurrencies because they are often riskier than other options. The majority of financial professionals advise including between 2 and 5% of your portfolio in cryptocurrency and being okay with the possibility of a loss. Bitcoin should be a part of your portfolio, according to renowned personal finance advisor and expert Susie Orman, as long as you can afford to lose that money and you're willing to hold it for a seriously long length of time. You may have heard a lot of tales about crypto millionaires who became rich overnight, but don't think it will be you. This is a risky investment that could result in huge gains but also substantial losses. When you're not jeopardizing your entire life savings, it can be entertaining to experiment with cryptocurrency investments, but it's crucial to have additional investments in areas with a larger possibility of return, such as real estate or index fund stocks. Even if you pay off each credit card on a monthly basis, having too many open credit cards can be dangerous. According to Julie Pukas, head of commercial product integration at TD Bank, having too many cards can have a detrimental impact both on your credit score and your ability to borrow money. Lenders could be concerned about what would happen if you used all of your available credit, even if you don't. According to MyFICO, the consumer component of FICO, the amount you owe is the second most significant factor in your credit score, behind payment history. Although having debt doesn't always affect your credit score, using a large portion of your available credit does. A high credit utilization ratio should be kept in mind since it can lower your credit score and give lenders the impression that you are a high-risk borrower. The best-scoring consumers only use 10% or less of their available credit. Your credit was verified when you applied for your credit card, but if you request a larger credit limit, your credit card issuer will probably do another credit check. According to Jerry Detweiler, a credit expert and education director for NAV, which aids company owners in managing their credit, this can be recorded as a credit inquiry, which could have an impact on your score. You could be tempted to consolidate debt if you have debts on numerous credit cards by moving them all on a single new card. But doing so can be a mistake. If you decide to close the other cards, it may also result in a decrease in the average age of your credit history and an increase in your debt-to-credit ratio. When making significant purchases, you must be cautious about the card you use. For instance, if you use a store credit card with a $1,000 maximum to purchase a $1,000 television, you've just maxed out your card, according to Alzheimer. Your credit score wouldn't be affected if you put the money on a different card with a $30,000 limit and minimal utilization, he said. However, if you use all of the credit on one card, particularly if it's your only card, your credit score may decrease by 50 points or more. If you discover an error on your credit report, you must take action to correct it and then check back to ensure that it has been fixed. If not, the error will continue to appear on your record and might lower your credit score. When a parking ticket is not promptly paid, several cities now notify a collection agency. A $35 fine for using an expired meter might balloon into a $500 issue that could negatively impact your credit history for years. Unbelievably, a $5 library fine might have a detrimental effect on your financial situation. Some cash-strapped institutions send overdue book penalties to collections, whereas many libraries disregard these tiny costs. A judgment is a matter of public record that appears on your credit report and lowers your score overall. Unfortunately, it can be difficult to get rid of these loans. Even if paying your rent late can damage your credit score, doing so won't help. If your landlord becomes irate over your late payments, they may file a credit bureau complaint against you. What do you think about this video? Do let us know down in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.